The main macroeconomic feature of the week will be the latest Purchasing Managers Indices, or PMIs, for the UK, and they will assess sentiment and activity levels across the manufacturing, construction and services industries. And these latest surveys are due out on Monday the 1st, Tuesday the 2nd and Wednesday the 3rd of April respectively. Remember that a reading above 50 generally equates to positive trading conditions and future growth, while one below 50 can be indicative of a slowdown or even a recession. Just to remind you that last month, manufacturing fell slightly to 52, its lowest score since last October. Construction dipped to 49.5, the worst score since last March. And services did actually improve a little to 51.3, although January's reading of 50.1, well, that had been the lowest on this count since July 2016, smack after the EU referendum vote. So, in sum, the UK economy seems to be bobbling along just above stall speed, as implied by the Office for Budget Responsibility's forecast of 1.2% GDP growth for 2019, followed by 1.4% for 2020. Anyone with exposure to stocks that are relying on the UK economy for the bulk of their business and profits will be looking for some improved momentum in these PMI surveys, I would suspect. Now, on the corporate front, just 4 FTSE 100 firms are scheduled to publish results, release a trading statement or host an analysts or shareholders annual general meeting. A number of mid and small caps are also due to report, and the most interesting names to watch, well, they could be as follows. Retailer Superdry will host a meeting for shareholders on Tuesday the 2nd of April, so they can vote on founder Julian Dunkerson's wish to return to the company's board. Then we've got Melrose Industries, that will be hosting an analysts day on Wednesday the 3rd, and that's pretty much a year on from its successful bid for GKN. AA and Topps Tiles will also update investors on trading. On Thursday the 4th, Megabank HSBC will host its annual general meeting, while Peppa Pig enthusiasts can look out for results from Entertainment One. And finally, on Friday the 5th of April, International Consolidated Airlines will publish its traffic and capacity statistics for the month of March. But the company which could cause the biggest fuss in the week ahead might just be another airline, easyJet, which is due to publish its interim or first half results on Friday the 5th of April. As we can see here, the share price has lost altitude pretty consistently over the past 12 months. A number of issues have been seemingly weighing on the shares, and they would include, and I'm afraid it's a pretty long list, a strong oil price and its impact on fuel bills, increased industry capacity and price competition, losses on the routes offered out of Berlin's Tegel airport as easyJet gets stuck into the competitive German market following an acquisition there, drones at Gatwick, which forced the cancellation of some 400 flights last December at a cost of around £10 million to the airline, the company's investigation of a deal to buy into bankrupt Italian airline Alitalia, and Brexit, where under EU law, UK-based airlines could, in theory, lose their licence to operate and access to Europe's Open Skies agreement if their shares are more than 50% owned by non-EU residents. Now, some of these issues, well, they look to have been laid to rest. The drones episode was a one-off, hopefully. easyJet's pulled out of the consortium and was looking at the bid for Alitalia, and the company has outlined its contingency plan with regard to its share register in the event of a hard or no deal Brexit to ensure it will comply with the EU ownership rules and therefore keep its licence to operate. 49.9% of shareholders are currently EU based, and the firm will simply suspend the voting rights of some shareholders on a last in first out basis to make sure that it hits that 50% plus one share threshold. Now, hopefully that means we can focus on the operational performance when we assess the interims. Remember, Chief Executive Johan Lundgren said that performance in the first quarter broadly met expectations, which might be code for didn't quite meet them, and back in January he refined the company's guidance for the full year. He flagged several key factors to watch. They were capacity growth, where easyJet now expects 15% year-on-year increase in the first half, 10% for the year as a whole. Revenue per seat is expected to drop at a mid to high single-digit rate in the first half, with Easter coming later than usual. Berlin's now expected to be in loss for the whole of this year, not just the first half. And fuel bills are expected to rise from around £1.15 billion to £1.46 billion thanks to higher oil prices. And we can see here, fuel is a huge swing factor. it's represented around a fifth of sales and a fifth of total costs last year. Currency movements are also expected to hit profits by around £10 million. So there are lots and lots of different moving parts there, but they will all feed into the headline pre-tax profit number. In the first half last year, easyJet lost £68 million at the pre-tax level, and as we can see here, the second half's the one that really counts. The first half's usually in the red for seasonal reasons. For the full year, analysts are expecting pre-tax profit of around £560 million. That's a little bit down from last year's £578 million on an underlying basis, and that excludes last year's £133 million of exceptional costs relating to IT spend and Berlin Tegel. Now, easyJet doesn't declare an interim dividend normally, just a final one alongside the full year results that come out in November. But just in case, analysts are expecting a low single-digit drop in earnings per share for the year to feed into a tiny reduction in the full year dividend to 58.3 pence a share. That's down from 58.6p last year. And that's enough overall for a dividend yield of around 5% at the moment. Thank you for watching, and I look forward to seeing you next time.